Hey guys, so I'm going to be going through Module 1 practice quiz. So the resolution's a bit funny because what I wanted to do is I wanted to keep my notes up on one side of the screen and the quiz on on the other side, just so I can show you what I'm doing. So you can get these notes from our website, you can purchase from the CPA notes, and I just wanted to show you how we can use the notes that we provide so that you can practice doing the quiz yourself and you understand, what's the process to do that. Okay, so let's just dive in. The first question is, assets are carried out the amount of cash or cash equivalents that could currently be obtained by selling the asset in orderly disposal. Which measurement basis does this describe? So straight away, you should know that this comes from the section where we covered measurement. So the options are value in use, historical cost, realizable value, and current cost. So what I'm going to do is I'm going to do Control F for all of these options. So value in use, actually I might do a less common one. I'll do current cost. There we go. So if we just go up here and see the image that we saw up here, you can see all the different measurement values that we talked about. You can see net realizable value, we've got value in use, and so forth. So we need to figure out which one. Assets are carried at the amount of cash or cash equivalent that could currently be obtained by selling the asset in an orderly disposal. Well, we know that value in use, if you've watched our videos, is to do with free cash flow and discounting it. Historical cost is basically what you bought it for. Now the only ones that we could probably narrow it down to is realizable value or current cost. So let's just quickly look at the definition of those two. So current cost is the cost of an equivalent asset at the measurement date. So it's nothing to do with disposal, it's more to do with the cost. So by deduction we know that it's realizable value. And we also know that the definition of realizable value is basically what you could, dispose of the business in an orderly sale, basically. So that one is C. Now moving on to question 2. Okay, so question 2 says, an entity provides their employees with 4 weeks of annual leave for each year of service. Unused leave may be carried forward and taken in future years. Should an employee leave the company, the employee is paid out any unused leave entitlement. Which of the following correctly describes this benefit in terms of IAS 19 employee benefits? Right, so the combination that we could do a Punnett square here is it's either going to be accumulating or non-accumulating, or it's going to be vesting or non-vesting. And if you remember from our video, accumulating basically means that it rolls forward. If you don't use it, it accumulates for the next year. So let's have a look in the question, see what's happening here. Entity provides their employees with 4 weeks of annual leave. Unused leave may be carried forward. So we know it's accumulating. Okay? And then the other alternate is vesting versus non-vesting. So vesting basically means, if you remember from our video, if the employee leaves, it has to be paid out. And if it doesn't have to be paid out, like for example sick leave, it's non-vesting. So based on this, we know that this benefit is accumulating and vesting because it says they can carry it forward and it's also paid out. So therefore, it is B. All right, moving on to question 3. Which of the following statements is true of general purpose financial statements? Now remember the difference, we talked about this in our videos, the difference between general purpose and special purpose is that general purpose is for a wide audience, right? And public companies and entities with reporting duties to the public and to key individuals would be general purpose, whereas if you're a private company, you don't have that wide audience, you just do special purpose. So let's have a look through the options. We need to find which one is true. So A, the objective of general purpose financial, I'm just going to say GPFS. GPFS is to provide information that will meet the needs of the maximum number of employees, unions, and legal representatives. So if you do remember, we talked about that the purpose of this is to meet the needs of the maximum number of people, right? But it does specify in this question maximum number of employees, unions, and legal representatives. However, there's more stakeholders than just those, so I'm thinking this is a trick question because it's to meet the maximum needs of stakeholders, not just these 3 here. Okay, B, the objective is to provide information that will meet the needs of all investors, lenders, and other creditors. Again, that's not the case because you're not going to meet all of them. If you remember talking about it from the textbook notes, is that you're never going to meet the needs of all of them, but you're trying to maximize it. Okay, the next one is the objective is to provide information that will meet the needs of users such as banks. You can, again, that's not correct either, right? So the objective of GPS is to provide information that will meet the needs of maximum number of investors, lenders, and other creditors. So currently this is the most likely one, but let's just to be sure, let's pull up the relevant section in our notes, and we can do that by searching GPFS. Actually, a better way to do it is to look for keywords that don't show up too often. Maybe maximum. Are we still in the right chapter? Let's start from the beginning. Let's go maximum. Okay, here we go. Provide the information that we need the maximum number of primary users. Okay, however, so now we need to figure out who the primary users are, what the definition of a primary user. So it's going to be investors, lenders, and other creditors. Okay, so it's going to be D, so the answer to this one is D. Hopefully that makes sense. The reason it's not this one is because these three parties are not primary users of the financial statements, the general purpose financial statements. Okay, so question 4. XYZ company is a publicly accountable for-profit entity. It is statutorily required to prepare financial reports in accordance with the accounting standards issued by XRB. XYZ should apply what tier criteria? So this is coming down to the 2 tiers that we talked about in the notes about how parties have, general purpose financial report. They either have, there's 2 tiers of requirements as, public reporting entities. There's tier 1, tier 2. So straight away we know it's not going to be tier 3 and tier 4. So it's either going to be tier 1 or tier 2. Now tier 1 and tier 2, the only difference was tier 2 had slightly less reporting requirements. But we know here that it's a publicly accountable for-profit entity, right? So most likely it's going to be tier 1. There's no indication that they have reduced reporting requirements. So let's do a control F for tier 1. Here we go. Okay, so tier 1 applies to for-profit private sectors with public accountability. Okay, so straight away we know it's tier 1. Question 5. Which of the following is a fundamental characteristic of useful financial information according to the conceptual framework? Okay, so if you remember the section where we went through fundamental characteristics versus, the value add component. So we just got to scroll up to find this section. Give me a second and I will find it. We could do a control F, but here we go here. So we've got the fundamental and we've got the enhancing qualitative characteristics. So the fundamental characteristics are relevance and faithful representation. Since faithful representation is not on this list, it must be relevance. So we know the answer is D. Alright, so that's the end of the Module 1 practice questions. Pretty straightforward. So we've got a few more on the next page. So question 6 is, what do financial statements prepared in accordance with the going concern assumption assume? So if you remember from what we talked about, going concern basically means that the company will continue to operate in future. And it's a common issue for auditors if they look at the financial statements and say this company's got too much, debt or too much short-term liabilities versus the current assets, or maybe revenues declining rapidly and they don't see it sustainable in the long term. They'll say this company doesn't have a going concern, and that'll result in a bad or a negative or a qualified audit opinion. So basically what this means is D, the entity will continue in operation for the foreseeable future. If it's a going concern, it's going to continue going basically in the future. So the answer is D. Alright, question 7. Which of the following statements is not an essential characteristic of a liability? Right, so if you remember, we went through the definition of what an asset and liability is. So we can bring this up in terms of what the key characteristics is, but we can probably figure it out just based off the top of our head. So the key components must be a present obligation. So we need to figure out what's not. Right, so it must be present obligation, transfer and economic resource, past events. So past events is in there. What else? So it doesn't have to be legally enforceable because it can arise from normal business practice. So we know that that's going to be a not. So the answer is going to be A. But let's just go through the other options just to just to make sure. So settlement of the obligation must result in an outflow of resources embodying economic. So we know that there needs to be a transfer of economic resources, so that's correct as well. The amount at which settlement of the obligation can take place can be measured reliably. So this one is also correct as well. So if you remember, okay, so it wasn't one of the 3 criteria, but it's going to the top level and saying, if you remember when we went through our notes, is if you can't actually measure something reliably under IFRS, you can't actually recognize it. We talked about here, we talked about it here, we talked about it here, we talked about it here in the notes. So everything, in order to be recognized, any liability needs to be measured reliably. So that is also correct. So we know the answer for this one is A. Alright, question 8. So Connex Pty Limited has developed several brands which have generated significant revenue for the company in the past and are expected to continue to generate revenue for the foreseeable future. In accordance with IAS 38 Intangible Assets, which of the following statements is correct? Okay, so this one's a little bit different because it actually covers intangible assets specifically. So there are some specific rules around intangible assets which don't apply to, assets generally. But nonetheless, let's have a go at answering this just within the framework of the elements of a financial statement. So first of all, remember the 3 components. Must be a right, must have a potential to produce future economic benefits, and the asset is controlled by the entity. So assets are considered to result from past events such as being purchased or produced. Thus it is important to distinguish between past events and future transactions, as it is not considered an asset until the event occurs. Alright, so let's have a look at this. So let's go through this. Is there a right? I mean, yes, they can control the brand, they can change it as they want, so that's true. Yes, it's got the potential to produce future economic benefits, so I mean, they've demonstrated that. And the asset is controlled by the entity, and that's also correct. However, this bit here is where it starts to trip up. Has it resulted from a past event? Yes, but can you distinguish it, right? Such as being purchased? No, it hasn't been purchased. Has it been produced? Not really, right? So it's hard for us to prove that this has resulted from a past event. So what I'm going to do is I'm actually going to pull up my notes, which also come with the Fin module, but this generally covers some stuff which is outside of the CPA module. But the reason I'm bringing it up now is because it's actually relevant here, is that, where is it? Here we go, here. So under IAS 38, paragraph 63 to 64, internally generated brands, mastheads, are actually prohibited from recognition. So the reason is they cannot be clearly separated from the cost of the development of an entity's business as a whole, right? So it's the past asset, the past event, which can't be, so that's it. You could have probably gotten that from the CPA notes alone within the CPA subject, but it doesn't explain it well enough, in my opinion. So I've had to refer to these external notes to actually show you exactly why this is prohibited, specifically prohibited. So we know that the brand should not be recognized. And then it's either A or B. So it's because it's impossible to measure the cost or value reliably, or because they do not meet the definition of an element of the financial statements. So if we go back to our CPA notes and figure out what are the elements of financial statements, well, its definition, did a past event or events give rise to an item that satisfies? It actually fails this one, right? And it also fails the measurement one. So the answer is this one. They do not meet the element of a financial statement. So it's B is the correct answer. Alright, so question 9. Which of the following are primary users of general purpose financial reports? I guess this one's pretty easy. We can just refer to the visualization that we looked at for an earlier question. So it was just, let me find it quickly. Where is it? Apologies for the delay. So here it is here. So it's just the investors, lenders, and other creditors. So investors, lenders, other creditors. So we know that it's going to be 1, 2, and 4. So 1, 2, and 4. Pretty easy. C. All right. And then finally, question 10 is an entity has 100 employees who are providing 10 working days sick leave each year on a non-vesting, right, accumulating basis. On 30 June 2016, 25 employees had taken their full entitlement, while the remaining employees had an average of 9 days accumulated sick leave. Employees had a 5-day working week. Based on past experience, the entity estimates that 25 use all their sick leave in the year of entitlement. 60 employees will take 6 days of accumulated sick leave. 15 employees will take 3 days of accumulated sick leave in the year subsequent to their accumulation. Assuming an average salary per employee of $50,000, what is the provision for sick leave the entity will make at 30 June 2016 in accordance with IAS 19 employee benefits? Guys, for this question, refer back to the section where we talked about vesting, non-vesting, accumulating, non-accumulating. And if you remember how we actually treat, so this one is basically accumulating and non-vesting. How we treat that is, if we just look through our notes and say accumulating but not vesting, so here we go here. The correct way to treat this, and that's basically sick leave, is the employee is only compensated for absences taken. Okay. So on termination, the employee is not compensated. Despite this, it can be argued that the definition of a liability is satisfied for unused benefits, which means there has been a past event that resulted in an obligation for accumulating non-vesting compensated absences to be carried forward as part of the employee's benefits. So what this is saying is, even though it's non-vesting, you still need a provision there for any payments in the next year that you need to make. For example, if staff have been accumulating sick leave and they're expected to take it in the next 12 months, you need to have a provision for that amount. If you're not expecting them to take, all of the days, then you don't necessarily raise a provision for it. It's only if it's probable that it's payment. So it depends on the probability that a payment is made, right? So basically the approach is we look at the people who we think are going to take sick leave in the next year, because A, they've got accumulated balance, B, a history of those employees shows that they're likely to take that accumulated sick leave. We're not going to raise a provision for the ones who use their entitlement in the same year, because then that's not a provision. Remember, the definition of provision is it's something that we're putting a pool together for the year after, for the next year. If it's within the same financial year, you don't raise provision, it just gets expensed, basically. So have a look at the question over here. So what we've got here is, so I always find these questions quite hard to read because you really got to look in the detail and figure out what's actually happening in terms of, but the key to remember is what we have to do, and that's to look for, ignore the ones that we know are going to take their leave in the current year. We just want to think about the ones in the next year who A, have an accumulated balance. So we're not talking about a new balance that they're paying out. We're talking about an accumulated balance from the prior year that we're expecting to pay out in the next year, and history has told us that they're most likely going to take that. So if we look at the estimates, so we've got 25 employees who use all their sick leave in the year of entitlement. That's fine, we don't need to provision for this. The reason is they're going to accrue 10 days of annual sick leave, and then they're going to take that 10 days of annual sick leave in the same year. So that's effectively going to get expensed. It's going to sit in wages, right? It's not going to be provision. We're after calculating the provision per IAS 19. Now, for the 60 employees, they'll take 6 days of accumulated, so see how it's accumulated from the prior year, they've accumulated this, in the year subsequent to their accumulation. So they're taking 6 days the year after. So we actually need to provision for this. And same for this, 15 employees will take 3 days of accumulated. So this satisfies the two conditions. Number one, they've got an accumulated balance. Number two, the history has told us that they're likely to take X number of days from that accumulated balance in the subsequent year to their accumulation. So both of these ones we need a provision for. So I've actually pulled together this calculator over here for you. I'll save it on the website so you can download it and use it yourself. So basically, the approach, let me just add in a title, sick leave provision calculator, IAS 19, employee benefits. Okay, so basically how it works is, first of all, okay, we need to know what the cost per day is, because obviously the provision's in dollars, not days. So we need to figure out, okay, so there's 52 weeks in the year, how many days are they working per week? it says in the question it's 5 days. So that means there's 260 working days in the year. And that's basically calculated as that times that. Next is the salary, because we want to work out what's the dollar value per day. So it says in the question the average salary is 50,000. So let's plug that in. So the cost per day is 192.307. Okay, next what we want to do is we want to take into account just the employees. Remember, I might write this down. Remember to only provision for employees who A, have an accumulated balance, and B, history has shown that they will take some of this balance in the subsequent year to accumulation. Do not provision for employees who accrue the full amount and take the same amount in the same year. This will just be expensed in wages, not a provision. Okay, that's just to kind of add some commentary to it. I'll make this kind of smaller as well. Okay, cool. So what we're going to do, we're going to ignore the 25 employees. So we're going to put in 25 0 so it doesn't show up. The next one we're going to do 60 employees. So we're going to take 6 days and they're going to take that in the subsequent year. So what this is doing here is it's saying, okay, so there's 360 days that they're going to that we need to be provisioning for. That's 6 days of accumulated leave times 60 employees, and then this just times that by the cost per day, because that's in days. And then we need to add in the 15 employees who take 3 days, so that's 45 days. You times that by the cost per day, you add this up, that's the provision total, so that's 77,885, so the answer is A. Cool, and that completes Module 1 multiple choice questions. Thanks for watching.